Welcome to the Investopoly podcast. Our goal is to share easy to understand, evidence-based, holistic insights to help you master the game of building wealth. It's Campbell Wallace here, and Happy New Year to all our listeners. I'm going to be jumping in for Stuart today, but Stuart will be with you very shortly within the next week, where he's going to break down his wealth first principles over a 4-part series, which will be quite good. But for today's episode, I just want to do some listener questions. We've still got a lot of these listener questions, which is great. Just for people at home, FYI, we're at about October, so sort of a 2-month sort of delay in getting around to these questions, but I think there's some really good ones in here, and I look forward to getting into it. So the first question is from Sarah. Sarah and her partner are 33, no kids. She mentions hopefully have some kids in the next couple of years. Before they met, her and her partner met each other, they both own houses, and they still do, in Newcastle. And so they live in her partner's property, but they rent out Sarah's one. So to give you some numbers on these properties, so the partner's property is worth $800,000 with $385,000 owing against it. And Sarah's property is $850,000 with $415,000 owing against it. And that property's rented out for $700 a week. She mentions that, the property that we're living in isn't the forever home, and they would like to upgrade in about 5 years, in lieu of a plan for kids and that sort of thing. She goes on to mention some additional information. The combined income of her and her partner is $235,000 combined. That's not including any rental income. Yeah, so both properties are kind of similar-ish values and similar debt against it. Got some decent equity. They're roughly about a 50% LVR, so there's some decent equity in there which is accessible and usable, which Sarah makes mention of. So the strategy Sarah is considering, she mentions that there's decent equity in both properties, so she's thinking about drawing $100,000 equity from each of the homes to buy an investment property for about $800,000. So it'll be a third property at around about that $800,000 mark. She mentions then any cash flow that we have after that sort of negative gearing or loan position for this new property, I would go into shares and ETFs, and it might be tight, but she thinks it's doable for the time being. So her questions are, do you see any issues with using equity from both properties to buy an investment property, which she mentions is a pure investment property? And her subsequent question is, will this restrict future investments into other property purchases? Sarah mentions here that, buying an investment grade property with that sort of budget, about $800,000 these days, can be more difficult, which I agree with. Thoughts are to use a buyer's agent, or she mentions with the current market, should we consider holding out for a few years until we have more borrowing capacity and just focus on shares for the time being? And she then mentions, this being their sort of first pure investment, you just don't want to make the wrong call in terms of structuring it and what it looks like. So any other considerations that we have to help her out? So Sarah, I don't see any issue. I don't think there's any large issue at all with using equity from 2 properties to go and buy an investment property. We've done this for clients. They might not have the sufficient equity in one, so then you can, you take security in another property as well. I don't have any big issues with that because, in time, as those properties hopefully grow, you refinance the debt so they're not sort of crossed across the properties anyway, and so then it's just secured against the property in future. So it's only a short-term thing, and I don't really have a big issue with it, to be honest. You draw the equity from wherever you need to, so that's not too much of an issue. But I think the big consideration here is you really need to think ahead, because if you go and do this strategy and buy another property for $800,000, it's absolutely going to restrict your potential borrowing capacity and potential to buy another property in the future. And as you've mentioned in this email that you've sent, that where you're living's not your forever home, you're planning to have kids soon, you're going to want to upgrade in the next 5 years. Well, if you go and buy another property and do this strategy, you're certainly not going to be able to do that. And I'd imagine that, I don't know how much the property is that you need to buy, but I'd guess it would need to be, that family home would be more than $800,000 in Newcastle. I mean, Newcastle's done incredibly well. I think you might need to spend at least $1 million to get that sort of more family home arrangement. So I think you've got to think ahead a little bit here. And I think, potentially looking to buy a property that could then, you can rent it out in the short term. We have no problems with that. But whenever someone's in a position where they could make it work to buy their forever home, and they know that they're going to be having kids soon, they know they're going to need more space, to go and buy an investment property when you know that, you've said here you want to upgrade in 5 years, it's just too short. I mean, you wouldn't be able to then buy that upgraded home as well. Definitely not. You'll be stretched on your borrowing capacity. And then if you're kind of thinking then, well, you just hold this property for 5 years and then sell it, or maybe sell a second property as well to then go into that home in 5 years, I wouldn't do that either. It's risky. With the cost of buying property, doing a short-term play like that in 5 years, I just don't think is the way to go. And there's a fair argument to say that, the property that you buy, well, how is that going to perform better than the forever home, the family home that you're looking to buy in 5 years? Probably not. I think generally the higher you go up the value scale, I think the better the quality of the property. So, you've got to you're trying to buy something for 800,000, hope that it does what it needs to do in 5 years, cover all your expenses and costs in doing so, stamp duty and whatnot, to then sell it, to then buy into a high value property, which has probably gone up in value as in terms of a capital growth rate, possibly more than the investment property that you bought. So it's all a very short time frame. So I don't think I'd be, if that's what you're thinking, I don't know whether you were thinking of buying this third property, then in 5 years, then you might be able to buy fourth property, which is the family home. But I think your incomes would have to significantly increase upon where they are at the moment. And if you think about, if you've mentioned here, planning kids in the next 1 to 2 years, well, there's going to be some time off work for you or maybe your partner. So, I mean, that always has an impact on income serviceability. So I think actually now probably sounds like a better time to borrow. I think you're going to have worse serviceability in the next few years as kids come about. And so I've run some numbers for you here, Sarah, because I think borrowing capacity is an important thing to consider here. So I've spoken about it a little bit before. We use just income times 5 as a very rough, very sort of broad-based assessment of total borrowing capacity. It's generally round about there. So if you add your incomes, so if we do your two incomes, which add up to 235,000, we can add in rental income. That gets shaved by the banks though. So I'm going to shave that by say 30% just to be conservative. So there's 36 grand rental income from the property you rent out. Shave 30% off that. If you add that as well, gets you to kind of total income of about 260,000. If you times that by 5, that's about 1.3 mil. And so that 1.3 mil, that's not additional borrowing capacity, that's total borrowing capacity based off your income. So if we then factor in, well, of that 1.3 mil, you've already got about 800,000 of debt against the current properties, then that leaves additional borrowing capacity of about 500,000. So I think the first strategy you've got the equity there, no dramas. I mean, if we look at equity in the properties, the combined value of your two properties is 1.65 mil, and you can use equity, and you can, leverage up to 80% of the value of those. So that's 1.3 mil. So you've got lots of equity. There's a good 520,000 of equity in there. So, there's plenty of equity, but to draw upon that equity, you've got to meet serviceability. And I think that you would only have additional borrowing capacity of about 500,000. So that's kind of the investment property. I think, that's a rough guide. It might be able to be 600, maybe even 700 if you got a mortgage broker that really goes after some aggressive lending. But I'd question whether you'd even get that 800,000 borrowing at the current standpoint. So, Sarah, I've spoken about it a little bit before, and I feel like maybe I harp on about it a lot. And I did an episode about, sort of weighing up a rent vesting strategy. And really, what I spoke about in that strategy is that for some people, it's the right thing to do, and it makes sense for some people in some circumstance. But generally, when you know that you're going to need you want to buy a home, you know where it's going to be, you know you're going to need to do it within the next 5 years, like you do. And if there's a possible strategy whereby you can get into that future forever home as soon as possible, I generally think it's the thing to do. I don't think, because otherwise we see it time and time again. You could go and buy another investment property, then you're completely leveraged up, and then 5 years' time you'll say, well, I really want to buy that family home. We need more space. We've got kids now. Don't have as much borrowing capacity now because my income's a bit lower. And then you're stuck. And then you have to go then selling a whole heap of properties, and then you're then buying into that property, that home, that forever home, in 5 years' time, in 5 years' prices. So locking that in as soon as possible, I think for most people, there's nuances, there's different circumstances, but I think for you, and this is not personal advice, but I think for generally information only, of course, but I think for people in your circumstances, I'd be trying to lock in that forever home. And if there's a way of doing it, I think you should. And in terms of the way to do it, a different strategy here, which I'd recommend I'd invite you to consider is so the problem with leveraging up hard like you are is that then when you eventually buy that home, say if you were to do that strategy, which I don't think works anyway, you'd then be left with a large amount of non-deductible debt once you move into that property. So, sometimes for some people, it's better to pay a bit of CGT, sell down a property, have really solid equity to put towards that home, and then you don't have to borrow as much, and then your loan to value ratio on that home's not as high. So then you've got not as much non-deductible debt against that property. So here's something to consider. If you were to go and sell your property for 850,000, 415,000 of debt, you'd clear out equity tax for, well, no, sorry, there'd be some capital gains tax depending on how long it's been rented out for, but however much that is, you'd clear about 435,000 minus some tax and costs and that sort of thing. And then by doing that, by reducing your overall debt position, it would increase the amount that you could borrow naturally because you've reduced debt, so then you've got extra debt. So I think you'd get about equity of 435,000. That would then increase the amount that you could go to the banks and borrow by about 920,000. So then with the equity and the borrowing, you could then go and buy that future forever home within a budget of about 1.3 to 1.4 mil. And I think based off my understanding Newcastle, I think, and I don't know your personal preferences with that, but I think that's a pretty decent budget. And I think that might get you into that forever home. Now, having said that, then you don't have to move into it straight away. You can stay in your partner's place, live there for, if that's convenient to you, get some tax benefit in terms of that new debt, that 900,000 of debt against it. But then you're in the market. It acts as an investment property for the next 5 years, but then you've got it earmarked as that forever home. It's a good family home for you and your partner and the kids. And then you can eventually move into it and you've locked it in today's prices. So that's something that you could do, but it's effectively upgrading or trading in one of your properties, because I don't think buying a third and then a fourth later on is quite possible for you. So that's something to consider, Sarah. And just addressing your point as well about, would the budget be enough to get something investment grade? Well, yeah, as I said, I don't think you'd have the 800,000 budget. I think it'd be, less than that, more like 500,000. And that's certainly not going to get you something investment grade. I think by potentially considering doing this sort of trading up and selling your property and then buying a better one, you're going to be getting investment grade at that point, I think, assuming you do it right and you use a buyer's agent to assist you with it to make sure you're buying a great property. But within just that general idea of that budget, I think that's going to ensure that it's going to be a much better asset. And then I generally think, you consider there, should you hold off doing anything and should you just invest in shares? No, I don't think I would. I think if it was me, I think I would consider trading up that property and locking in that forever home. I've said this before. I think it's about you got to lock in the big assets early, and particularly when you have better borrowing capacity. And if you know that there's going to be, with kids and whatever, there's going to be a diluting or reduction of your borrowing capacity in the near future, using the gearing, using the leverage whilst you can and locking in the big assets. And then once that's in place, then afterwards, that's when you start building up shares. You work out your cash flow. Okay, we've got an extra, a few $1,000s a month, whatever, we can start building up a share portfolio. I'd do that after, but I always reckon when you're young, you're 33, you're sort of trying to build the foundations of your wealth and your position. I think it's about locking in those properties early. So that's what I do. I hope that helps, Sarah. The next question is from George. George mentions that he's recently come across the podcast and he's binged it. He's actually listened to almost all the episodes over the last month. My gosh, you've been at it, George. I think there's over 370 or 380 or something episodes. So you've done well to do that in the last month. But yeah, that's fantastic. Thanks for your feedback there. George mentions that he moved to Australia with his wife and kids. He's got a wife and 2 kids. Moved to Australia about 12 years ago. He's currently 42 years old. And he's having to think about his current state and what to do over the next 15 to 20 years over his working life as he leads up to retirement. And he's provided some information about his current situation. So I'll give you a high-level summary of it. So good incomes. So if I just do combined with him and his wife, base salary combined $350,000. There's some bonuses there combined of $45,000. And then George he gets an employee share arrangement, and that's roughly $50,000 per annum. And it's for I won't say what the company is, but it is a listed company. So they're fully tradable, those stocks that he gets given. Super, they have $335,000 combined. They've got some insurance cover there. I sort of won't touch on that. That's okay. They currently live in a home which is a duplex, and he thinks it's worth about $970,000. It's got about $750,000 of debt, but he's got about $330,000 in offset count. So the real debt's not too high. But then they're planning to sell that place because he has mentioned, it's got lower growth rates, the duplex, it's got, some high expenses and it's not performing too well. So a range of reasons that he's mapped out there that they plan to sell that, and they have already bought the new home that they're going to be moving into in June next year, or this year, sorry, this is 2026 now. So the new place is worth 1.7 mil. There's going to be 1.3 mil debt against it. Obviously, then whatever, the equity of about 220,000 out of current home plus the offset account money, that'll come across into offset for that new property as well. Outside of that, he has, they both have shares. So I won't go through and list them all out, but look, total value about 208,000 in shares, and about 100,000 of that, it's worth noting, is his employee shares, which give full details, but vesting, there's a vesting period, which is very common, doesn't have full access to all of them, but a good 100,000 of the 200,000 shares that they have is in that one company, and it's partially vested. So that'll sort of come through and actually be available to him in time. So George has then mapped out a bit of a plan here, and he's, wants our feedback on the plan. So the plan, if I'm to summarize this, is a lot of info here, but the plan entails, as I mentioned, selling the current home. He then wants to look at buying 4 investment properties and have a sizable share portfolio over the next 15 to 20 years. So he's considering a good structure for these investment properties and inheritance and for asset protection and that sort of thing. And he's leaning towards a discretionary family trust with 5 beneficiaries, being his wife, 2 kids, and a corporate beneficiary, or bucket company as they used to be known as. And he's considering buying the investment properties and doing the share investing through the trust. And he's then, mentions here that you can then pay out the income to the corporate beneficiary, which gets taxed at 25%. It's actually 30%, George, but minor difference. His plan with his employee shares, about 50,000 that he gets allocated per annum, is when they vest, sell them immediately, thereby reducing any capital gains, put that towards the home loan and then redraw on that. He's also then considering, he wants to build up, so to reduce concentration to the company that he works for and the large exposure in those shares that he has, wants to sort of get a bit more broad-based in his ETF portfolio. Yep, that's great, George, I agree. He's mentioned a couple of internally geared ETF options here. I like those. I think we've spoken about it a little bit before in the podcast, but you've got to have the stomach for it, and you've got to realize, you've got to understand the timing of when you're going into it, and then you need to consider the timing of what you're going into in a geared strategy. But I definitely think, and we've spoken about it internally, that even for our clients, I think there's a time and place to go into a geared strategy in our portfolios. I mean, personally, I have definitely, and for clients, we have for some. But I think you've just got to understand where the market sits, and you've got to really be long term about that, because they swing both ways, those internally geared ones. But if you're a long-term investor and you get in at a decent entry point, I'm all for it. I think that over the long run, they're going to add a lot more alpha, a lot more capital through that internally geared. They run at about 50% gearing internally, so it just sort of amplifies the ups and it amplifies the downs as well. So, but I'm certainly for them. I think there's a time and place for them, George. And then thinking longer term, George has mentioned here, he's considering not fully paying off their current home, or not their current home, the one they're going to be moving into this year, because they might end up downsizing in about 20 years at the point of retirement into something smaller. So he's wondering, whether it's worth paying off the mortgage in full. So he's considering that. Okay, so that's a bit of a snapshot of the goal and his position. It's quite a lot of information here, but George has got a bunch of questions here. Let me go through them one by one and just give some comments and some thoughts. So first question is, is the plan worth the effort and the cost of the spend? Or is it better to continue investing in personal name, assuming the next 2 properties will be negatively geared? So I think he's referring to, having these entities, and he's mentioned, his accountants gave an indication for the cost, the accounting fees for running a trust and 2 companies would be about $2,500. So, it needs to be worth it. There needs to be merit, obviously. So generally, the problem you've got, George, is we don't like it a lot. So when you buy a residential property and it's investment properties, you want to use as much gearing, you want to borrow as much as possible, because then that maximizes the deductible debt, and then you can put more towards paying down non-deductible debt. And then in doing so, the properties are going to be negatively geared. And so then if you do that through a trust, what happens is you borrow the money personally based off your personal income and based off the equity in your home to get the deposit loan, and then it gets on-lent into the trust. And so then what that means is you don't get the negative gearing, the trust gets the negative gearing. Now the issue there is that you trap losses, income losses, in a trust. They don't get to be paid out. You've asked a question a little bit further on here, I'm jumping ahead, about can you use the losses in the trust to then offset your personal income, which you're in the top tax bracket at 47%, and no, you can't. So that's the problem with it. Now I'm jumping ahead to another question as well. You've asked, do the losses get accrued in the trust and then therefore used against future income or capital gains? Yes, they do. So that is true. So you could end up getting the benefits once the property and shares in the trust eventually gets it to a point of being cash flow positive, and then when there's capital events as well. So you do get to use them eventually, but we don't like it. We really try not to have trusts running at a loss, because you got to think about the value of money. Like the value of, future value versus the today's value, getting a deduction in today is so much more valuable than delaying it, accruing these capital losses or income losses for then a future point, which might be years and years down the track to then eventually get it. We don't like that. We like negative gearing to happen and get the tax benefit immediately. So that would be our preference. And we're really not too big on, look, if you buy a property in a trust and there's other things in the trust, or if you happen to be a business owner, so there's business income coming through the trust, then you get the negative gearing, no problems, and you get the tax benefit. So I'm not completely against buying properties in the trust, but if there's going to be a case where you're just going to be trapping losses for 10, 15, 20 years, we're not a big fan of that. And it's not so much that we're a fan of it. We've mapped it out a number of times, and it's just not beneficial not getting the tax benefit in year one immediately. So George has a question here. He's thinking about how can he get his $200,000 share portfolio into the trust without triggering the CGT event. Well, you can't really, George. It's a CGT event. That's a change of beneficial ownership going from personal names into the trust, and it triggers CGT. So there's sort of no way of avoiding that. So George asks a question, can I accumulate franking credits received by the trust from share investments within either the trust or the company, which is the corporate beneficiary he's talking about, and then pay that out to individuals later on down the track once retired? So yes, you can. And that's a really effective strategy we've seen in doing work for clients where they have this arrangement. So that would only be, so once the trust is positive income, it's positive cash flow, you can then use the corporate beneficiary to cap the tax rate at 30%, which you've sort of outlined here. And then you then retain the credit for that tax paid in the company as a form of franking credits. That balance builds up. And then over time, once you get to retirement, then you can then pay dividends out from the company, have flexibility in doing that if the corporate beneficiary shares are owned by the family trust, because then it pays dividends into the trust, and then you can choose to go to you, your wife, kids, wherever you go from there. You have flexibility in doing that. So yeah, absolutely, that is one of the benefits, is you get to keep the franking credits in your own company, and it's really quite tax effective. I've mapped it out a number of times. You can pay out really large dividends from that company, and because of the franking credits and because you don't have much other assessable income once you're retired, you really don't pay much top-up tax at all, and you can distribute quite a lot. It's almost up to about 190, 200,000 you can pay out without not paying much additional tax. So yes, that's certainly something that can be done. And George has one final question here, which is about, through his work, he has the option to buy shares as part of the employee share scheme, and they allow him to buy them. So this is on top of the 50 grand odd that he gets per year as just an allocation, but he also has another option to buy shares in the company at a 15% discount. And he says they're taxed up front, and the 15% discount is reported as assessable income by the ATO. Yes, absolutely it is. You cannot remunerate employees, in this way without it being assessable income. So I've been asked that question before. Do you get to just buy these shares at a 15% discount to the market? No, it's based off when you receive them. They look at market value. If you bought them at a 15% discount, well, that 15% that's remuneration to you. So you have to pay tax on that. I've actually done this very interestingly for another client of mine who asked me this exact question. I've done the numbers on it. Pretty much buying at a discount, it's a benefit to you, because you pay tax on the 15% discount that you're being received because it's treated as remuneration. But then, if you factor in your tax at the 47% tax rate, you're still netting better off. You're basically being given money. Yeah, you've got to pay tax on that 15% discount, but then you keep the roughly 7.5% benefit. Think of it just like additional remuneration. So on top of your salary, bonus, current annual allotment of shares, this extra discount is just another form of remuneration. So to your question, do I think you should do it? Yes, I think you should. I think there's nuance to this. Don't take this fully broad base, but really whenever there's an option and it's not going to impact any of your other remuneration, it's just an additional form of remuneration. If you can buy at a discount, well, it just makes sense to do so, I think. And so George's question is, does it make sense to buy as much as possible, sell it immediately when it vests? He mentions that we spoke about this in a podcast previously. I think Stuart did. Look, generally, yes, I would think so. Yeah, because I think selling them when they vest is the way to go. If it's a listed company, which the company you work for is, you're going to pay tax on it like it's income. So the tax bill's coming. And then, you've already got a high concentration in this stocks. So I don't think you need to be building up more. So why hold on to it? I think better to pay the tax, which is coming for the income, sell it, reduce your exposure, which it's also a concentration risk because it's the place that you work at as well. So there's kind of added concentration risk. Treat it just like income, I think, for most people in most circumstances. And then when it vests, that's when you're starting to get taxed. That's when you sell it and you pay your tax on it, and then do what you will with it afterwards. So rounding things out here for George, and it's a bit of a long one here, but George, I think your plans around selling the current home once you move into the new place in June, that sounds like a good idea. Whether you buy 4 investment properties after this, I'm not sure. I mean, you've got good income. There's good income there, and it looks like you've got good surplus cash flow. So whether it's 4 or whether it's maybe 1 or 2 in your plan over the next 20 years, I'm not quite sure, but 4 might be a bit of a stretch. I'd urge you to, rather than, if you've got the option of buying 4 for, I don't know, say it's like 6 or 700,000 each, or instead buying 2 or buying 1, go less and go higher quality. So there's no, I don't think that it's overstated in some ways, the idea of splitting it, breaking it down into 4 so you've got diversification, because diversification's great, but if you're going down on the quality element, then you're better. I think it's better having 1 or 2 really high quality investment grade properties. So just keep that in mind. I've mentioned about, what I think about doing, having negative gearing in the trust, not huge on it. As a general rule, I think gearing, you can have gearing in the trust, but I think if it's, thinking about a share portfolio, it's got to stay below about 40 to 50% gearing ratio in a trust. That just ensures that the trust as a whole is still just breaking even or cash flow positive. So as long as it's doing that, that's okay. But having it massively negative geared and trapping all those losses, I don't think, from experience, I don't think it's beneficial. But you might still have a trust, because I think you've got really good surplus cash flow. I think a family trust, I believe maybe there would be merit in it, given, you're going to be building up a substantial share portfolio over time. With all these stocks that you've got with these discounts and annual allotments, I think you're going to be building up, and you've got really good surplus cash flow. So I feel like a family trust is going to be beneficial for you. But, I'd urge you to maybe get some advice on it and run some numbers of your own to project where you think that portfolio is going to get to, and then what that extrapolates to in terms of income. And you can kind of weigh up the cost to benefit analysis there, George. I hope that helps. Okay, next question is from John. John writes, I have a accumulation super account with individual shareholdings and ETFs with a sizable balance of about $1 million. John will be transferring to pension phase in about 3 months' time, and he mentions he has about 20,000 in realised capital losses. Is there anything he should be doing with the capital loss, like sell some of my profitable positions to offset the capital losses, or just watch the capital loss disappear during the transition process? So it sounds as though I was just hesitant when I said realised capital losses, but I think it is correct. I was thinking maybe John was saying there's unrealised losses on some of the investments, but no, I think that's right. What he said is there's realised losses. So he sold some investments recently whilst in accumulation phase. So there's been some loss positions, but he's about to convert to pension phase, which clears out any capital gains, and effectively the capital loss is going to disappear. So he's thinking, should I go and sell some investments that are a capital gain in order to then offset that capital loss, or should I just let it play out? So, John, I think no, unless there is something that really you feel as though needs to be sold, or it looks like it's getting a bit overinflated, or if you don't think it's a great investment long term, perhaps, but there's actually no difference from a tax outcome. I mean, if you sell them now before you enter into pension phase, you make sure that the capital gains is less than or equal to that 20,000 of capital losses, then there won't be any tax outcome. And the tax outcomes, it's 15% in accumulation phase, but it is something. But as long as you could realize some gains of up to 20,000, so it would be offset by the losses, or you wait 3 months until you start pension phase, and then there's no capital gains on anything you sell anyway. So it's net. It's from a tax perspective, there is no difference really whether you wait until pension phase to sell investments. It would all just come down to whether you think there is something in the next 3 months that really needs to be sold. I know it can kind of feel as though you're losing an opportunity there with the capital losses. You're kind of thinking, oh, they're going to be lost forever then, and they will. Yeah, you're right. But that is what it is, and I don't think there's any reason to just go selling something now just to use the capital losses if the investments are still good. I mean, there's no point doing that. If they're investments that you think you're going to hold in your super fund for, the course of retirement, then selling them just for, to use the capital losses and not pay any capital gains on it doesn't make sense, because within 3 months you'll have no capital gains in your super fund anyway of any kind. So all comes down to the investments there. No difference from a tax perspective, John. I hope that helps. Okay, I'm just going to squeeze in one more question here, and it's from Derek. Yes, he's happy for me to use that name. It's from Derek. And Derek's question relates to the episode called How to Avoid the 17% Super Death Tax. That's one that I recorded, so I thought I'd address this question here, and it's a great one from Derek. He said, look, in relation to that episode, taking this second super fund thought one step further, if one's earlier on in their accumulation phase and has not yet meaningfully made any non-concessional contributions to super, would it potentially make sense to have two super funds? So one would contain their employer concessional and any other sort of deductible concessional contributions, and then the second super fund holds all of the non-concessional, so the non-tax deductible ones, the ones that go in and form the tax-free component of super funds. So concessional contributions form taxable component, non-concessional contributions form tax-free component in super. So he's sort of highlighting you can really segregate those two things if you were going to be making, some decent non-concessional contributions which go in as tax-free. So he's sort of talking about segregating it, and he's saying it would mean there is more taxable funds to recontribute, wouldn't it? Absolutely, Derek. You're spot on, certainly. And, when I first wrote that blog, that was how I got the idea of the smarter recontribution strategy about having the separate super funds. And that's what prompted it. It's actually a piece of work that we did for a client of ours who was a bit late to the piece because they moved to Australia a bit later. So they were a bit behind on super fund, but they had a lot of money to contribute from their other investments. So they were going to be doing some really aggressive non-concessional contributions because they're getting pretty close to retirement and they know they really need to build up that money. So they were going to be making a lot, maximizing the 120 per year non-concessional contributions for the husband and wife. So in their circumstance, we looked at it and we worked through it and we said, no, yeah, let's do it. Let's do a separate super fund. So the whole idea from the podcast, from that blog, came from that for a client that's doing it. So yes, absolutely. That's going to make the eventual recontribution strategy more effective. And it's going to, because it allows you're already segregating the taxable and tax-free components into two different super funds. So again, this comes back to Derek, if you're considering it, how aggressive the non-concessional contributions, if you're going to be doing, 20 or 30 grand, I'd think, every year for a few years before retirement, I don't know, is that going to be worth it? But if they're going to be substantial and you're going to do it for a number of years, as it was for this client of mine that we recommended this strategy for, then yes, certainly. It allows you just to segregate those components and it could definitely be worthwhile. Great question, Derek. Okay, I'm going to wrap it up there. That's all the time we have, but until next time, bye for now.
Before we wrap up, I've got a quick request. Apple and Spotify decide whether this show reaches you, and I never want to lose that connection. Email is the only channel I truly own. If you're comfortable, please leave me your email. I will not spam you. Each Wednesday, I'll send you one email with an update of new blogs, episodes, presentations, and videos that I've published. All content. Just visit investopoly.com.au/email to subscribe. Thanks a lot.